Jim Lebenthal. You talk about, buying high. You better hope these things are going to continue to work. You bought Amazon.
I was wondering how you were going to set that up.
Mr. Valuation.
Wait a second. I was wondering how you were going to set that up because I heard.
How did I do?
I heard. Well, you did not disappoint. You never do. But folks, this is not an expensive stock. Pause for impact. It's not an expensive stock. I got you 40 times forward earnings. Listen, there's a new sheriff in town, Andrew Jassy. They're not spending as much in R&D as they used to. They're still spending a lot, but there's a lot of earnings that have been hidden for quite some time that are being uncovered. I think that 40 times multiple is frankly too high. I think the earnings are going to come in higher. Fundamentally, you can see that in terms of a fully employed consumer. Look at weekly jobless claims today. That's going to continue to buy on the internet as well as Amazon Web Services. But putting this together, when I say it's inexpensive, the PEG ratio, again, mentioned it earlier, that's the price to earnings ratio versus the long-term growth rate, is 1.5. That is very attractive for a stock. And last thing, and probably should have led with this. Over the last 3.5 years, the stock has gone nowhere. I mean, it has been dead money for 3.5 years. I think that's a huge base. I mean, I'll appeal to, the technician here.
Would you be surprised if it turns out that this is the secret stock that Berkshire Hathaway is accumulating?
Interesting.
Would you be totally shocked? I wouldn't.
No, I wouldn't.
It's one of the few stocks that's big enough to move the needle.
Okay.
It's a stock that he has publicly said, and Charlie, rest in peace, has said they missed it. They should have been smart enough to buy it. Stock's done nothing for 3 years. This is my guess for when we get that. And I own Berkshire too, so I'll be double exposed.
Me too.
This is my guess. I think this is what they're buying.
But can we acknowledge this
sold Paramount Global, by the way, Berkshire. It's like a lot of clues.
Geez, really? Let me get that knife out of my back.
We'll get to Berkshire stuff coming up in a little bit. But Steph, I want your take too, because you own Amazon, and again, tried and true value investor at some point said, you got to pay up.
It's not expensive.
You got to pay up for growth for great companies.
I bought it in October when the stock fell on the quarter that was supposedly bad, and I just thought it was really good. And there's a lot of ways to win with AWS accelerating, retail margins going higher, free cash flow going through the roof. And so I think you're right. Jassy, actually, the CEO does have better discipline, but I want him to continue to spend. And so I do think
they're going to spend like $100 billion on R&D.
Yeah, 40 times is not expensive, but again,
it's not 40 times.
If you can get acceleration in AWS, that will be very, very important. And that's the margin driver. So I think that's really a key. And remember, like the last 10 years, the stock has traded at like 100 times.
Can I posit that you can't, as value investors, you can't necessarily, I guess I want your takes on this. It's a question. I'm not trying to make a declarative statement. Can you necessarily look at valuation today the same way you would a couple of decades ago, just based on growth in areas like cloud and AI? In which NVIDIA and Amazon, which once both of you as bottoms-up value investors would say, absolutely no touch, no way. And here I have both of you in two stocks that have at various times, including in some respects now for NVIDIA, been deemed as the poster stocks of high valuation, high growth.
First and foremost, I was buying Amazon at 600. You remember that. That was way, way, way low. And then I sold it, which was a bad move, but I made so much money on it. Sometimes you have to look at valuation relative to its historical average and sometimes on an absolute basis. And maybe it's justifying missing a stock and trying to get into, but I don't think you can ignore all of these total addressable markets of what you just said, all of these various different pieces. This is the real deal. And so I want to have exposure to that. And I'm trying to figure out if, when something gets more attractive, again, relative to its self.
I hear you, but I do remember when you first bought Amazon, it was maybe five years ago, 6 years ago, something like that. And for a lot of value investors, you'd say, well, why don't you own Amazon? And it was really nothing more than it's just too expensive.
I've been having this fight with these people, Judge. I've been having this fight with these people for years and years. One of the things that I have always said, come on.
I know.
One of the things I've always said is that traditional measures of valuation, number one, are backward looking, but number two, did not envision the dominance of these types of companies. Amazon decided.
Hey, listen.
Well, hold on. Amazon decided 4 years ago, hey, guess what? We're going to start an advertising business. It's the third largest advertising business in the world.
Brother.
3 years later, how do you value on a price earnings basis a company that can decide to do that?
Brother Josh, I got you. Here's the thing when we talk about valuation. I know it drives you crazy. Sometimes you're right. Sometimes Steph and I are right. Okay? If you were buying this stock 3.5 years ago, it has been a dog for the last 3.5 years.
Not because of valuation.
Fine. What I'm saying, hang on a second there, my hot friend, okay? What I'm saying is I am not turning in my value card, okay? I'm not giving up my credentials.
No, you're just putting it in the drawer and pretending like you don't have it.
No,
it's like you're taking off your wedding ring, walking into a party.
It is nothing
we know
like
what
that.
you're doing, Jimmy.
God, what are you saying? That's awful.
It did not. Wait a second. It did not underperform for 3. It did not underperform for 3 years because of COVID. It underperformed because they couldn't deliver operating leverage. They couldn't deliver the top at the same time the bottom line.
Guys.
Right? Margins were depressed.
That's not a valuation issue. It's execution.
Peg ratio. Value is about the peg ratio. It's not about buying stocks at 5 times earnings that can't grow their earnings. That interests nobody, including value investors. If you're growing your earnings at 26%, which is what FactSet thinks is the long-term growth rate for Amazon, I think that's too low. A 40 times multiple is a very attractive price to pay for it. I'm done.
All right.